Potentia Wealth brings you the Power of Wealthness podcast.
Welcome to the Power of Wealthness. Todd, as we are empowering our clients to live their lives confidently, one of the major aspects that they deal with, one of the major investments they have in their lives is their home or income property as an investment. I think this is an important topic for us to cover. It's one of the reasons that we've brought in Ryan Leeder from Cal Financial. Ryan, welcome.
Thank you. Thank you for having me. Happy to be here. Excited to be chatting about the current mortgage world and how to help your clients and really everybody get into real estate to build their broader portfolio. I have been in the business for almost 15 years now, working for different mortgage brokerages and mortgage banks, originally from Wisconsin. Now a California Bay Area transplant for 20 years, so crazy. And spend my free time, I guess, hanging out with my family. I got a young son, and we spend as much time as possible on the golf course.
Nice. Another golfer.
Hard not to be in the Bay Area.
So when we're talking about loans for real estate, what type of loans are out there? What are you seeing today?
Traditionally, you have your 30-year fixed rate mortgages, where you will have a mortgage that's set for, your rate is set for 30 years, 25 years, 20 years, 15 years. There's all kinds of different options there. Traditionally, you'll find 30 years being what most people have. And then we can also look at adjustable rate mortgages, with mortgage rates being a little bit higher than really anybody would like to see. There are some adjustable rate mortgages that generally are a slightly lower rate, not tremendously lower, but slightly lower. And they'll be fixed for a shorter amount of time, generally 5, 7, 10 years. And after that initial fixed period is when it will adjust according to the market at that time. So the goal is always then to refinance into something long-term and fixed prior to that period ending.
In a previous life, I was in real estate, and I remember working with my mother, who was a broker, and she had a listing for a house that had an assumable loan for 8%. And it was in the last few years of that loan, and I thought 8%, wow, I never thought I would see interest rates so low.
Yeah, well, that's definitely the case. If you look back, I think that's something that's good for people to look at, because currently rates being in the 6s, 7%, 6%, 7%, somewhere in there, it's pretty normal for the big picture of mortgages. If you look back, 40, 50 years, the average is somewhere in that space. We've been a bit jaded in the past decade and a half or so. We had the financial crisis of 2007, 8, 9, 10, and we came out of that. Rates were really low. So if you got into the market in the last 15 years, rates were in the 3s at that time, and they kind of crept back up. And we got pretty close to the 5% range, and then COVID happened. And that's when things, obviously, everybody kind of knows the current state. And now we've swung back up to the other side of that spectrum. So it's definitely a ebb and flow, but 6%, it's not far off from the normal space.
Yeah.
Where are you seeing the most interest from your clients now? Is it adjustable rates because of the interest rate piece, or are they still trying to lock in for the long term? What's demand like?
I would say it's still finding that most people end up in a 30-year fixed mortgage. The other part of rates being up higher is the adjustable rates don't have as much of a gap anymore as they maybe did prior to, say, COVID. Say today you're getting 6.5% on a 30-year fixed. We might be able to go find an adjustable rate mortgage that's closer to 6 or into the 5s possibly. But we've got to look at the big picture of that as really, what is that savings? Is there any cost to that loan? What are the different aspects of the bigger picture? And are we going to be refinancing in that period to get you into something better, or, are we chancing it?
I guess that's where you have the discussion about points as well, buying down a loan as to how long you plan on having it.
Exactly. The old rule used to be, if you're gonna, basically, if you're buying points or paying additional costs for your mortgage, you want to break even on that cost within the next, say, 2.5, 3 years. So You're paying $1,000 up front. Let's make sure we're saving $1,000, more than $1,000 over the next couple of years.
Back in the early 2000s, they were giving away mortgages. Then after the financial crisis, it was basically you had to give a pint of blood along with oodles of paperwork to get qualified for anything. What's the qualification look like today?
Mixed bag, definitely a mixed bag. I mean, we're still in a space where there's a lot of red tape, a lot of documentation, all of the above. But that's if you want the lowest rate, the lowest cost, the best terms on the market. We look at it. I look at it from a sliding scale. If you want the best loan with the lowest cost and the lowest rate, you're probably going to have to jump through the most hoops. The bank's going to be very conservative in their rules. They're really going to put you through the ringer, make sure that you're getting it. But as you slide off of that scale and you want some leniency from the bank, maybe the rates go up a little bit, cost goes up a little bit, documentation usually goes down or what they're looking at. So the nice part is we have all of the traditional mortgages, 30-year fix that is, Fannie Mae, Freddie Mac, government backed, low rates, low cost. And we can go really far off of that spectrum. You talked about prior to the previous financial crisis, the mortgage world had a lot to do with that. We still have some very interesting similar type loans to that time, but there's a lot more protections involved. So if you don't qualify for a traditional mortgage, we have some options that are much less documentation. You just pay a little bit more is generally the situation.
So are these if we were to take a look at the different types of lenders out there that you can borrow from, I guess you got the big banks, mortgage companies, and then through a mortgage broker like yourself. What types of loans are you going to be seeing from those institutions?
So the big banks, your depository lenders, they're taking in money, they're lending it back out. Your Wells Fargo's, Chase, B of A, those guys. They're great at what they do. They're generally within one lane, though, or a very singular lane of low rates and straightforward W-2 borrowers that have pretty clean profiles. So if you're an outside the box borrower, you're self-employed, maybe you own some businesses, some other real estate, a little more complex financial scenario, the big banks might not be the best fit. Just they tend to I don't want to say stumble more, but you got to jump through a lot more hoops generally with them if you're not just working at Google, making a couple $100,000 and you're putting down your 20% and you're going to deposit $500,000 in, and they're going to offer you some kind of incentive for that. The far end of the spectrum is a mortgage broker, which is who I work for. We're a nationwide brokerage. Majority of the states, I'll say there's probably 10 or so that aren't in there, but we can usually find a home in most states. We have the broad selection of options. So everything from the big bank products, low rate, low cost, to some really outside the box. So when we talk about different programs, say, for example, a good scenario is like I just closed for a client down south in LA County. They're actors. Their tax returns are not very attractive. They don't file a lot of income. They write off most things. So from a bank's perspective, if you can't show it on paper, then you're probably not going to get the A paper loan, which is totally fine. There's alternative options for you. This one was, if they had 35% down, they were willing to put 12 months of payments into a 13-month CD with the bank was going to give them a loan. So it was, there was more to that puzzle, certainly, but the key was larger down payment, put 12 months, make sure you got 12 months of payments in the bank because they'll start pulling them if they need to. And they were able to finance a primary residence that, the bigger banks or a traditional lender maybe wasn't able to get done. Simply
by reducing the risk that the lender was having to take.
They give them it's a 5-year adjustable. So an adjustable rate mortgage, like we talked about, is 5 years. And the goal was, we had the discussion up front, is now you need to talk to your CPA, you need to talk to your financial planner. And within the next 3 years, we need to put together a plan to get your tax returns in order, or at least get you to the next tier of financing where we can document some, maybe get you into a 30-year fixed.
That's excellent. See, and that's what we try to get to. It's for our clients, it's not about the approval process necessarily, although it is when you get to those more esoteric or nuanced pieces, but it's about optimizing that lending piece since it is such a big piece of the portfolio. So it's great to hear that those options are there. What are some of the biggest mistakes that people are making when they go for a home loan?
I think just making assumptions, right? There's a lot, you can find a lot of information on the internet. Part of it's going to apply to you. A lot of it's not going to apply, right? Everybody's scenario is different, especially if you're moving away from your, like I said, your standard W-2 salary borrower. There's a lot of different options out there. So don't disqualify yourself before you jump on the boat. Our goal is to ultimately put the paperwork together. That's the hard part. It's not really too hard. I'm here to help, and my team is here to help with that. But then we can put a plan on paper. How do we start from here where we don't know what we can get to the finish line of you buying a house, and make sure you're making a good decision along the way. Generally in our market, especially here in the Bay Area, you find a house and then you get pre-approved. But you're scrambling, right? If it's a A+ property, regardless of the market and where you live, if you are after the A+ property, the A property that everybody walks into and is like, oh, I want that one, then you have to be prepared ahead of time because you want to be able to put your best foot forward. You want your real estate agent to be able to write a clean offer. I want to be able to call the seller's agent and be like, hey, we've been doing this. We're ready to go. You're well qualified. You have great credit. The whole shebang. What do we need to do to win this offer? And that's ultimately what you're trying to do when you're buying a house is win it, get the best deal, and close efficiently for the seller. So
that's excellent. You talked about these actors. That's a pretty nuanced and niche market. What about people that have RSUs or wealth but it's tied up in different compensation? How does that work? Being that we're here in the Valley.
Yeah, I love RSUs. I mean, it's a huge component, especially here in the Bay Area and generally, I think now broader spectrum for companies. But we can actually use that without you pulling any of that money out. We can look at the history of what you've received, what you will receive over the next 3 years, average that in and actually use that as qualifying income to help you purchase possibly more home or qualify for different products. You can certainly cash out any of your RSUs and use it for assets. We are going to count anything that's vested as reserve funds. It's your money. But yeah, it's great for using for both income and reserves without having to necessarily touch it and continue to let it go.
As our clients are looking for investment properties, are they looked at the same way when it comes to qualifying for mortgages?
In general, they are looked at from a collateral standpoint. Yes, the great part about an investment property is that we can use the projected income, or if it's already leased out, we can use the lease income that is already coming in for that property to, again, help qualify. If we're using projected rents, when they order the appraisal on the property when you're buying it to make sure it's valued at what you're purchasing it for, the appraisal will actually do a rent survey to get market rents, and then the lender uses 75% of those as another income line for your qualifying.
So when I'm qualifying for a loan myself, my income counts dollar for dollar, but my income property's income counts at 75%.
Right. So they're counting 75% of your future rental income, taking into account that you're going to have about 25% of your income coming in as an expense to maintain that property.
What about, and I've been getting hit with this question a lot more, housing prices are so high, even nationally. In fact, it just came out, there was a survey of the top 10 most expensive cities in the world, and 4 of them are here in California. 3 are in the Bay Area. I mean, it's shocking. Clients are asking about helping the next generation with down payments, et cetera. How does that feed in if a parent or a grandparent starts to help out financially?
Yeah, absolutely. So a couple different ways that family can help out. One, with down payment. And so from our perspective, from a lender's perspective, any family or like family can give down payment as a gift. In some scenarios, they'll want to see a little bit coming from the client, but in most cases, you can get 100% gift. So if your parents, grandparents, anybody wanted to gift you 10%, 20% down, whatever it may be, we can use that as down payment, and you wouldn't have to come up with any funds.
Yeah, Todd, just for clarification, you are like family to me, so you can lend me money anytime.
I was going to ask you the same question at the close, so there you go.
Houses are expensive out here. And then also we could have a co-signer. So generally family, they want to, if your child doesn't quite qualify, but we want to get in, because certainly getting in is the key. They can co-sign, and we're going to look at the application the same way, just stacked on top. What is that co-signer's monthly obligations added with the new obligations, coupling all the income together?
Back in the 80s, we saw a lot of equity shares where parents or investors were putting the down payment, and other people were moving into the home, making the payments, and taking care of the property. Are you seeing much of that anymore?
I would say not as much anymore, just because it's hard to move on if you don't get your money coming back right away.
It's difficult.
But that is so true. I think it's, I have to think it's probably something in other areas of the country that's maybe a little more, it happens a little more often. But exactly as I passed, my mother-in-law just said it the other day. She's like, when we moved here in, 1990, the seller was so generous, and basically like we didn't have enough down payment. So she said, I will lend you the remainder, and they eventually paid her back and moved in. But they were able to get in to a bigger place because the seller was willing to work with them. That's Midwest nice. Yes. but speaking to that point, I think the current market is a deal making market. We're in a market where if you have the A+ property, like I said, it's going to sell. It's going to sell for top dollar. There's going to be people who want to buy it. The kids got to go to school. We have limited, great school districts, all of the above. But everybody's selling houses. There's still some unique ones out there. There's ones that are B and C properties that sellers are like, I need to sell this thing. How do we sell it? So use that to your advantage as a buyer, because it's no longer just like, give me top dollar. How fast can you close? And I just line up the offers. Now it's, my property's been on the market. I need to sell it. How can I help the buyer to get in? So I think that it may not be an equity share, but it may be closing costs, credits, buying down the rate is a huge one right now. We have it's been going on for some time now, but they call it a 2-1 buy down, where the seller, the agent, the loan officer, the client could even pay an upfront fee that basically prepays the interest for the next 2 years. The first year, if you say you're going to lock in your 30-year fixed at 6%, you get 2% off the first year, 1% off the second year, and then the third year it goes back to 6%. So you go 4% for the first year, 5% for the second year, and then it jumps back up. And hopefully within the next 2 years, we'll refinance. But at least you're saving a bunch of money over the first 2 years with that program.
So you're guessing, number one, or you're hoping, number one, that you're making more income, you'll be in a better financial position, but you're also taking the risk of interest rates increasing or changing. Where do you see interest rates in the next year or 2 years?
It's definitely been the crystal ball. We've been waiting for it, the cloud to clear as we shake it, but it's a lot of talk with the Fed right now. Certainly is what everybody is watching. The Fed comes out, and their conversations certainly dictate what's going on with all the financial markets. It seems like we're kind of hanging tight. We really follow Fannie Mae. So if you look at Fannie Mae, you can Google Fannie Mae. They are the mortgage leaders, the rulers of the mortgage world. Their analytics are generally very close. They're saying 6.4 by the end of 2025 and 6% by the end of 2026. Right now, we're kind of hanging in that mid-6 space. So we're almost to the end of the year. Seems pretty spot on. And then we'll wait and see what the Fed has to say in the next meeting. I think they're still waiting. It's still a wait and see moment, appears to be. But as they make comments, the Fed rate will impact short-term rates. Everything else kind of trickles down, generally impacts the 10-year treasury, which is what the mortgage rates follow. So if you're watching different things, they all impact each other.
So we watch the treasury yield curve a lot, as well as if we see the Fed lowering interest rates by a quarter point, half a point, will we expect a decrease in the longer term interest rates, quarter point, half a point as well?
They don't correlate straight down the line. So, if you're getting 6.5% and the Fed comes out and says we're cutting rates by 0.5%, 6% is not, the new 30-year fixed. But it will trickle itself down. The nice part is the mortgage world generally knows what the comments are. They're predicting what the comments are going to be. So we build it in. We'll see that rates start coming down leading up to these big meetings. And then the comments will come out, and either the comments will cause a stir and rates will spike back up, or they'll kind of just hover where they've already dropped into. The last year and a half, 2 years has certainly been a bit of a roller coaster where you just need to be prepared. Kind of going back to that original comment is get yourself set up, turn in your paperwork, put an application together. Don't worry about the credit piece. Have a conversation with your loan officer. You don't need to pull your credit a million times and be concerned about, dinging your credit score. But the key is to be prepared. So when the rates do come down, you're going to have a moment and you'll need to act on it. So it's just something to be really, especially in this market, I think being prepared is a key piece.
You brought up the interest rates in Fannie and Freddie. From the investment world, there's been grumblings about them being privatized. I'm just curious if you have any perspective coming from an actual participant in the loan market, what that impact would be if they did go private.
It's a good question. I think, a lot of that is, the red tape and what we had touched on previously with documentation and what you have to do to get a mortgage these days. It's a lot. And a lot of it is, they came out of the crash and put in all these new rules and regulations, but really it's to protect the consumer. There's no question about it. It also is confusing for the consumer. So there's this balance that I think the idea of being able to maybe unwind that process just a little bit. It can still protect the consumer, but you also need to make it understandable. If it's confusing for people in the industry that are doing it on a day-to-day basis, not confusing, but if it's a lot to understand for somebody who does it on a daily basis, for somebody who doesn't ever do the process and is buying a house, it's daunting.
The complexity's increased greatly over the
right.
last
You got
15
enough
years.
things to think about and sign, and yeah.
You talked about starting early, getting pre-qualification, going through that process so that you're ready when you find the house to move on it. How soon should someone be coming in and having a discussion with you?
Gosh, I as soon as you're thinking about it, honestly, because there's no obligation. I think you should always be starting your conversation with kind of your financial team, right? What does your financial planner think and know you should do with your money? What can you do with your money? And then what do you qualify from a loan perspective to buy? And then also your tax professional. What is the end goal after you know what you're going to do with your money? You know what you qualify for and what kind of house you're going to buy. We can put together a plan. Then you can take that to your CPA and see what are the implications of that. And hopefully, how are they going to benefit you next time you file your taxes? But I like getting it done as early as possible. If you're going to buy next year in 2026, we can do it now. If you're going to buy next week, we can do it now. But the longer you have to think about it, the more the more time you'll have to put a good plan in place.
If I've got a client who is looking to buy something, just don't feel that they're qualified today, so they're looking into the future, will you take the time to sit down with them and put a plan in place for them and help them to get to that goal?
Yeah, absolutely. So that is kind of the key. Is that we have three kind of main pillars of qualification. We're going to look at income. We're going to look at the assets. So what do you have in the bank for down payment and reserves, but also the collateral that you're going to buy, and then your credit. So those three things are kind of the main pieces for the bank. Credit being a huge one. Regardless, we can do credit down to 600, 580, 500, really low scores. But I don't want to get you a loan at those because they're going to be expensive. So if we pull a soft credit and we say, we can make a couple tweaks here, and all of a sudden your score jumps to 720, you're going to get a much better option. The other piece is if you have time to fix it, credit is a tough system to get through. So if you do have some blemishes that maybe you just didn't even know about, you'll have time to take care of them prior to needing to write an offer. We live in a market, especially out here, where it's, like I said, find the house, get qualified, write the offer. It's really nice to get qualified, find the house, and execute on it. Sellers want a buyer that's ready to go. That's the key.
And you brought up something interesting, similar topic, but so many folks are lucky that they have mortgages now that are sub 3%. And, there's this idea that they're never going to turn over. Now, if people are coming in at 6 or 6.5 or even 5.5, what's your process to help optimize later, 2-3 years down the road? Do you follow up and say, hey, now rates are lower, we can refinance, or there's a different program because of your RSUs? How's that work out for clients ongoing?
Yeah, absolutely. So we're always keeping an eye on rates. I mean, that's the key. So if there's an option to refinance, generally the cost to refinance a loan are significantly less than purchasing a home. So we're always looking low cost, no cost refinances, and then just finding that opportune time. Certainly now is a little bit different than when we were refinancing during COVID and everybody was refinancing. But again, same thing. Get into something that's long term. I think if you can get something in the 6 space right now, that is pretty good spot to be. But it's definitely going to be something that we are always watching and always looking to, refinance.
And as you're building your financial coaching team, it's important to include the financial advisors in that conversation as well. And you had mentioned that.
Yeah.
Todd, you were just talking about what I could versus what I should purchase.
Exactly. The idea that I don't know anybody that's walked into a home and said, this one's perfect. And then they walk into a larger, better home and say, oh, I'm okay with that first one I walked into. It's I'd like to stretch a little bit further. So how do you work with that on the emotional side? I know that's what Kevin and I focus on. Do you do that from the lending side as well?
Yeah, of course. I mean, I think when you see the numbers on paper, it certainly will make that decision a little bit easier. But yeah, we want to line it up and really when we go through the nuts and the bolts of what you specifically qualify, it's great to know, rates are in the 6s and you can get these kind of loans, but everybody's different. What your neighbor got and what you're going to get, they're going to be different. So we want to tailor it specific to you and we're going to line it up. Max purchase price. What do you qualify? What is the bank going to give you from a max perspective? In most cases, you're probably going to say, I don't want that. Because the banks are going to qualify you for generally a little bit more. We're looking at gross income. We're looking at different aspects of the income versus what you're actually bringing home. So how does what you bring home fit with what the bank can qualify for, along with all the other components of your life, and then finding the big beautiful house to marry it all together.
And making sure that you've got the proper balance. Is the big, beautiful house, you're locking your money up into that house. It's illiquid. So do you have the liquidity you need on the other side to make sure that you're able to pay the bills and put the kids in school and do the things that are priorities for you today? Because if interest rates were to go up, the only way to pull your money out is to pay a higher interest rate for a refinance.
Yeah, exactly. Yeah, if it's needed, that's for sure.
I want to say thank you for coming in to our listeners. If you'd like to have a conversation with Ryan, or if they would like to sit down and do some planning with you, we'll have a URL that's provided that they can follow.
Call, text, email, all of the above. I'm always available, so don't hesitate. And not only just to find out what you qualify for. I'm more than happy to answer questions, be a resource, better understanding of what's going on. So never hesitate to reach out. My phone's always available. You can reach me at 408-459-8544. And I really appreciate you guys having me on.
And as part of that financial resource team for our clients, we've got our other podcasts with good information. So like us, follow us, or connect with us as well. You can subscribe to our podcast also. And we look forward to our future conversations. Thank you.
Thank you, guys.
Thank you for listening to the Power of Wealthness podcast. Click the follow button to be notified when new episodes become available. Visit our website at potentiawealth.com or give us a call at 408-288-7886. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Potentia Wealth or Potentia RIA. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Potentia RIA LLC, a registered investment advisor.